Live from London, this is Bloomberg Daybreak Europe. I'm Lizzie Burden with your top stories. No deal on Hormuz. Iran rejects talks with the US and an agreement with Oman remains elusive, pushing oil prices higher once again. Meanwhile, Israel rejects the Trump-backed plan to disarm Hamas, stalling diplomatic progress on the war in Gaza. And Chinese factory gate inflation eases for the first time since the Iran war. And consumer price growth slows, raising deflation concerns as pressure from the energy price shock fades. Well, a very good morning. Happy Monday. Here's where we start the week in markets. Oil, as I say, extending gains as that Iran-Oman deal on Hormuz remains elusive, and after the Houthi militants claimed an attack on a Saudi refinery in the Red Sea. So Brent trading just shy of $84 a barrel, up 0.5%. Meanwhile, treasuries giving back some of Friday's gains. They had rallied after that unexpectedly weak July employment report, prompting traders to dial back rate hike bets, cementing the biggest weekly gain on the 2-year since May. But that's reversing now. We've got the 2-year yield up a basis point at 4.2%, and the dollar rebounding here from a 2-month low. The Bloomberg Dollar Spot Index currently higher 0.2%. Now let's turn to the equities and futures picture. Despite the oil price gains, we have global stocks trading near a record high. Asian traders renewing bets on AI after a month of volatility. So we're up 0.5% on the MSCI Asia Pacific Index. And it's a mixed picture both sides of the Atlantic, but pretty flat to start the week when it comes to futures. Now, let's take a look at what could change all of that throughout the week. The risk events ahead. On Wednesday, it's the data highlight of the week. Following on from Friday's US jobs report, we'll get US CPI. So forecast to rebound a touch. Key for bond investors, but also mind the Treasury auctions this week. We also get a monthly market outlook from all three of the major oil forecasting agencies, the EIA, the EA and OPEC. Bit of an alphabet soup there for you, but of course in focus as ever given the Middle East war. And then on Friday here in the UK, we'll get the latest GDP data. The question being how much that energy shock has impacted the economy and how much the hot weather and the World Cup have offset that effect. If demand is strong, maybe we see the Bank of England hiking this year. So plenty ahead. Let's get started. We begin with oil extending its recent gains as a final deal to reopen the Strait of Hormuz between Iran and Oman remains elusive. While Tehran ruled out direct talks with the US, President Trump says Washington is, quote, semi-negotiating and can wait for Iran's economic suffering to soften its stance. Iran's foreign minister says an agreement with Oman is very close, but negotiations with Washington cannot yet begin.
At present, we are not engaged in any negotiations with the United States. As long as the American violation of the Memorandum of Understanding continues and the U.S. does not make amends for its violations, there is no possibility of resuming negotiations.
For more, I'm joined by Bloomberg Horizons Middle East and Africa anchor Abir Abu Omar. Abir, good morning to you. Just talk us through how soon it looks like we could see an Iran-Oman deal and where the U.S. is in all of this. Seems like nowhere.
Yeah, good morning, Lizzie. Well, those were the same questions we were asking ourselves last week. If you remember, the U.S.'s involvement, according to Iran, is nowhere to be seen. They maintain the fact that the ongoing negotiations are happening between themselves and Oman and merely on a mechanism to reopen the Strait of Hormuz. Now, where that is, final stages, that is the line that we have been hearing from Iranian officials, including Foreign Minister Abbas Araghchi over the past week. Now, what exactly are the delays, or why exactly the delays are happening? Our understanding is they're just trying to find out exactly a way for ships and vessels to be able to make their way through the Strait of Hormuz. Earlier last week, Lizzie, we had reported that there would be a mechanism for outbound ships to make their way through the borders close to the Iranian border orders, and then for inbound ships to do the opposite, so closer to the Omani side. But the delays are there. We understand that the negotiations are still happening between Oman and Iran. Meanwhile, we also understand that ships and tankers are still at the risk of being hit in the Strait of Hormuz. The latest example of that, of course, was the Adnoc flagged ship over the weekend that was hit with one fatality, more than a dozen injuries there. And so Iran is still threatening or still targeting ships that are going through the Strait of Hormuz. And then, of course, the parallel danger by the Yemen-based Houthis, Iran-backed, on Saudi energy facilities. The latest we know is that a Jizan a plant in Jizan, Aramco plant, was hit over the weekend as well. No fatalities there, but we understand as well that Aramco said that it caught fire. It was extinguished, although the Yemen-based Houthis continue to pose those threats on Saudi Arabia, the Red Sea, of course. And so that is the situation over the weekend. We still don't have a deal. President Trump saying he wants to maintain the economic pressure on Iran for the time being, not returning to a state of warfare. And so a lot of unknowns for the time being. We still await that formalized deal possibly happening this week.
And of course, the hits to infrastructure will take the recovery longer to process. Meanwhile, we've seen this shake-up in Iran's top security team. I wonder what that means for the diplomatic situation.
Yeah, you're right. So that happened over the weekend. We still are unsure how exactly it would have an impact on diplomacy or wider diplomatic talks. But what we know for a fact is that some hardliners were shuffled in different positions. The concessions, Lizzie, that Iran has been asking for. You heard the foreign minister speaking earlier at the top of this show saying that as long as the U.S. continues intervening and as long as the U.S. does not respect the concessions that were reached during that MOU in June in Switzerland, Iran will not back down, essentially. And then the shuffling of those hardliners, Iran has come back to the table through some of those hardliners and started asking for concessions, including oil sanctions being lifted, including blocked assets being unblocked. Now, we haven't heard of those concessions throughout the past month or so. The main goal in all of these talks was the Strait of Hormuz and reopening the Strait of Hormuz and getting energy flows back flowing in the waterway. But now we're going back to these hardliners, upping the ante, essentially, on what they will require out of the United States to essentially agree to a mechanism that would reopen the Strait of Hormuz. The response from the U.S., Lizzie, has been in the shape of President Trump saying that he's okay, he's playing it low-key. As a matter of fact, that is what he said, and that he will wait for Iran's economy to run its course. We know that inflation in Iran year on year is about 77% higher. So yes, it is taking a toll on Iran. But then again, we've reported multiple times that it takes Iran very, very cheap. It is very cheap for Iran to produce those drones that pose the risk on vessels and tankers in the Strait of Hormuz. So now it's a game of, again, back and forth between the United States and Iran. And then the tensions in the Middle East are leading, of course, energy prices, including Brent, to roam around the $84, $85 on the barrel. So an escalation back and forth and wait and see yet again, Lizzie.
Well, I'm looking at Calstri odds of Hormuz traffic returning to normal by next year, about 40% as things stand. Abir, thank you for the update. That's Bloomberg's Abir Abu Omar. Well, as we see higher oil prices, we're nonetheless seeing Asian stocks moving higher this morning, picking up from the green on Wall Street after Friday's weak jobs report. Let's go now to Winnie Xu in Hong Kong. She's got the latest for us. Winnie, what should we be focused on in Asian markets?
Yeah, good morning, Lizzie. Well, it is quite a nice, stable setup in Asian stocks today. As you mentioned, tracking those gains from the U.S. on Friday, especially coming after data pointing to a softer U.S. jobs number. Now, we are seeing tech stocks leading gains today, especially in Japan and in Taiwan. However, the weakness actually is more in the Korean market. As you see, investors have been pulling away their money from the single stock leveraged ETFs tied to the likes of SK Hynix and Samsung Electronics. electronics. And the money, in fact, is actually rotating into the small cap cage. The Kosdaq index here up more than 6% because of how volatility in the Kospi really coming down to a 2-month low, while investors look for more opportunities to capture further volatility in that gauge. Now, flip the board, we take a look at the latest data when it comes to China inflation numbers. We have quite a bit of a disappointment when it comes to both PPI and CPI. When you look at factory inflation here, up 3.5% for July, it is under estimate of 3.9%. And more interestingly, it is actually also undershooting the prior month number at 4.1%. And that is the very first slowdown that we saw since PPI turned positive in March. So combining that weakness in both CPI and PPI, it goes to show how the deflation risk in China is really coming back, and that this is really being driven by not just the energy prices coming down, but also the continuous weakness that we see in China's consumer demand. Now, flip the board across asset-wise, we are taking a look at just how the impact of higher oil is affecting markets, because higher oil, stronger US dollar, weighing on some of the key currencies in Asia, and specifically we are highlighting the Japanese yen here. We did see a bit of a strengthening on Friday following those US jobs number, but that gain really didn't sustain because we are seeing a weakness by about 0.4% today, and that is coming despite the Bank of Japan's summary of opinion pointing to upside risk for prices and also potentially earlier rate hikes. Because at this point, investors already pretty much pricing in a guaranteed rate hike in October, and given that wide rate differentials between the US and Japan, quite skeptical in terms of how much further this sustainable rally for Japan can be. Now, when it comes to yield space, we are seeing Japan yields really tracking those gains that we saw in Treasury yields overnight. Back to you, Lizzie.
Winnie, thank you. That's Bloomberg's Winnie Su. 158 per dollar is where we are on the yen. Well, let's turn back to the inflation data, but this time the numbers coming out of the US on Wednesday set to be a headline and a busy week for economic data overall. Investors reassessing the Fed outlook in the wake of that softer than expected jobs report on Friday. Investors now expecting a narrow increase for July following a 0.4% slide last month. So let's go to Ven Ram, cross-asset strategist at Bloomberg MLive. Ven, the July jobs report, unexpectedly weak, as I say. Now we're looking ahead to CPI. How much of a rise in CPI would it take to revive the Fed hike bets? Good morning.
Morning, Lizzie. I think it'll take a considerable beat on the upside for the numbers to upend the Fed calculations. Now, look, we got, as you mentioned, we got those very weak jobs data last week, and the markets were kind of thinking, you know what, there are explanations to this because of the seasonal government jobs data and all that. But the fact remains that the bulk of the economists did not foresee that coming. So to the extent that they did not see that coming, it was a downside nasty surprise. And the 2-month revision was also negative. The labor force part, the jobless rate ticked lower, but it was because of lower participation rate. So all in, the jobs report data didn't do anything for the Fed to be raising rates. So even with a beat, modest beat this week, I don't expect the Fed rate pricing to firm up convincingly, because I think that, look, I mean, we have been missing the Fed has been missing the inflation target for 5 years now. If that hasn't compelled them to raise rates so far, they are not going to do that after that jobs report, because they're going to simply wait for more data to confirm which way the economy is headed.
OK, well, of course, the bond market will be watching that print. We're also keeping a close eye on Treasury Secretary Scott Bessent, not least after Washington's yen-intervention. And I wonder how successfully you think Bessent can weigh on long yen yields in this environment.
Well, he's a bit of a snake oil salesman trying to package treasuries is the best thing in the market because, as you mentioned, he's in all over the yen intervention. He's for making sure that, the Japanese do not sell treasuries. But at the end of the day, the bond market is the bond market. It's the ultimate in the world. There is nothing like it. As John LeBron said, if I want to be born again, I want to be born as the bond market. So I think that, look, I mean, you can't fool around with the bond market, as the UK knows very well, right? So from recent episodes, bond vigilantes are there to extract a pound of flesh, because they're the people who actually bankroll debt. And if their coupons are going to be corroded by inflation, they're going to have a vociferous tumult. And no matter what Besant tries, that'll show up in the bond market.
I think the nation's top bond salesman is how Besant would put it, not a snake oil salesman. But Ben, thank you very much for your analysis. That was Bloomberg MLive strategist Ben Ram. Well, still ahead on Daybreak Europe, Maersk headlines Europe's earnings this week with soaring container rates expected to drive a bumper second quarter. So we'll take you through what to watch when it comes to earnings. But first, we'll stay with the geopolitics. Israeli Prime Minister Benjamin Netanyahu rejecting a proposal by US-backed mediators for disarming Hamas. That story next. This is Bloomberg. Welcome back to Bloomberg Daybreak Europe, 6:17 a.m. here in London. Now back to the Middle East. Israeli Prime Minister Benjamin Netanyahu has rejected a proposal for disarming Hamas. Netanyahu was responding to a roadmap published by the Board of Peace, backed by President Trump.
Israel rejects the 15-point plan. The IDF will not carry out any withdrawal until Hamas is disarmed. And when I say disarming Hamas, it means the heavy weapons, the less heavy weapons, and the light weapons. All of the weapons. And we are talking about real disarmament, not a fictitious disarmament.
For more, we're joined by Bloomberg's Dan Williams. We can go to him in Jerusalem now. Dan, good morning. So, given this Israeli rejection, where does it leave the roadmap, and what are the alternatives if Israel's not going to back this plan?
The roadmap is still the plan, albeit one that was drafted and submitted to Israel and Hamas with a view to receiving their caveats, their misgivings, their requests for a rewrite. This really is all a work in process. Nikolai Mladenov, the top diplomat for the Board of Peace, that's that international consortium tasked with implementing President Trump's plan for shifting Gaza from its ceasefire back in October to long-term peacemaking. Mladenov has been talking privately that getting this done is a bit like constructing a car while driving it. That gives you the sense that there is some improvisation, there is some, should we say, lawyerly language being used in the documents in order to get both sides on board. Netanyahu's position, as stated yesterday, while dramatic on the face of it, shouldn't be a big surprise. He had previously voiced misgivings about this roadmap. The roadmap is the bridging proposal meant to shift between phases of that Trump plan. And specifically, he did this after Hamas issued its own hedged consent to the roadmap, meaning Hamas talked only about giving up its heavy weapons, not the tens of thousands of rifles still held by its men. It also tried to front load some of the more aspirational endpoint aspects of the Trump plan, specifically a full Israeli withdrawal from the Gaza Strip and the creation of a Palestinian state. Hamas tried to front load that into this stage of the negotiations, this stage of the process. What the Israelis are saying now is they're rejecting that. They want a full verified disarmament of Hamas, and also they have no interest in a Palestinian state. This is not something that should come as a surprise to anyone, not least as the Israeli election is in October. Netanyahu is running to extend his already record term. He needs to prevent right-wing and far-right votes from hemorrhaging, and he had received some blowback in his cabinet from far-right partners about this roadmap. What he's doing is hardening his rhetoric while not necessarily torpedoing the roadmap. There are indications that it's proceeding on the ground quietly, away from public view. There is no alternative that I'm aware of, nor at this point does it appear that there's a need for an alternative.
OK, so it could come back to political posturing domestically in Israel. Dan, thank you for the analysis. That's Dan Williams in Jerusalem. Now, Adnoc gas deliveries in the second quarter has delivered second quarter income that beat estimates. And next up, we'll bring you more of our interview with the company's CFO. That's next. This is Bloomberg. Welcome back to Bloomberg Daybreak Europe. Now to one of our top interviews. After its earnings, Adnoc Gas has reported 52% drop in second quarter net income to $665 million as the Middle East conflict has disrupted shipping through the Strait of Hormuz. But the results did still beat the average analyst estimate, and the company's CFO has been speaking to Bloomberg's Abir Abu Omar.
We have our long-term investments programs announced today. We're going to invest another $8.2 billion in new gas facilities, which we are building because we see demand for gas growing. We see that happening in the UAE, an extremely resilient market, but also demand for gas, in particular the Asian markets, remains very strong. Now, on the back of that growth outlook, company is investing in new infrastructure. In the period 23 to 2030, we have a committed capex amount of $28 billion, and that underpins the growth in our EBITDA. In that same period, our EBITDA will grow by 60%, and it shows the confidence that we've got in demand growth in both the local market and the international markets, where we supply products like LPG and LNG and condensate.
So with the environment right now, Peter, and everything that has been happening, and you spoke a little bit about infrastructure, has the latest war or the geopolitical tensions, have they accelerated your prospects for developing LNG infrastructure outside of the Gulf?
We today have 6 MTPA of LNG production up and running, which is inside the Arabian Gulf. We're building another 9.6 MTPA facility in Ruwais, but we're also exploring other options. And today we're looking at what these options look like. There is no decisions made, but the company, of course, has a focus on managing today challenging environment, which you've seen the numbers, has resulted in very strong net income of $665 million. But at the same time, we look forward. We look forward with that investment in that we announced today, new facilities, and also, to your question, looking at how can make the company even more resilient, whereby you would look at options of locations on the east coast of the UAE.
The reality of the situation in the Strait of Hormuz is that ships are still getting attacked or are at the risk of attacking. The latest from this weekend, including an Adnoc vessel. So when you factor all of this in, do you put in additional costs to your balance sheet that you have not previously accounted for?
So, good question, because there are, in our estimates that we give to the markets, always ranges. Example, 600 to 800 million for the third quarter of net income. For the full year, $3.5 to $4 billion. Those ranges have all to do with how many ships can cross the Strait of Hormuz. And that crossing or lack of crossing does sometimes have an impact on cost. So far, we have seen that the suppliers, vendors, people are quite flexible and are starting to adapt. You cannot deny that there is an impact, but at the same time, when we look at our investment programs, we use EPC contracts, whereby we very much manage the schedule, but an EPC contract provides us with a lot of protection for cost increases.
The Adnoc Gas CFO Peter van Driel speaking there. Now to some other top corporate news for you this morning. Berkshire Hathaway has spent about $4.5 billion to buy back its own shares in the second quarter. It also purchased nearly $20 billion of equities, signs that the CEO, Greg Abel, is putting more of the firm's cash pile to work. And that is one of the top corporate news stories this morning. But coming up, Europe's earnings season enters its final stretch. So we'll bring you a preview with Chloe Melly next. Stay with us. This is Bloomberg. Live from London, this is Bloomberg Daybreak Europe. I'm Lizzie Burden with your top stories. No deal on Hormuz. Iran rejects talks with the US and an agreement with Oman remains elusive, pushing oil prices higher once again. Meanwhile, Israel rejects the Trump-backed plan to disarm Hamas, stalling diplomatic progress on the war in Gaza. And Chinese factory gate inflation eases for the first time since the Iran war. And consumer price growth, meanwhile, slows, raising deflation concerns as pressure from the energy price shock fades. Well, a very good morning. If you are just joining us, 6:30 a.m. here in London. This is the picture in markets to start the week. Oil, as you can see, extending gains as that Iran-Oman deal on Hormuz remains elusive. We have Brent here just shy of $84 a barrel. Therefore, Treasuries giving back some of Friday's gains. You're looking at the two-year yield up a basis point at 4.2%. But, of course, Treasuries had rallied off the back of that unexpectedly weak July employment report. It had prompted traders to dial back rate hike bets, cementing the biggest weekly gain on the 2-year since May. But now, as I say, that reversing. The dollar, meanwhile, rebounding from a 2-month low. So the Bloomberg Dollar Spot Index up about 0.2%. Now, if we flip over to the stocks picture, despite the oil price gains, we've got global stocks trading near a record high. Asian traders renewing bets on artificial intelligence after that huge month of volatility. But for now, futures on both sides of the Atlantic trading in a narrow range and pointing in opposite directions. Now, let's take a look at the front pages this Monday morning, and we'll start with the Financial Times. It's leading on a story describing China bypassing traditional shipping routes through the Arctic as the melting polar ice shortens the journey between Europe and Asia. Meanwhile, if we flip over to the Wall Street Journal, it's reporting on its analysis showing increasing signs of stress in the private credit market, even as the industry strikes this upbeat tone after a year of turmoil. And then if we come to the UK, the Times says that Prime Minister Andy Burnham's struggling to convince prominent economist Lord O'Neill, to take a role in his government, in part because of fears over calls from some for a wealth tax. Well, you can get a roundup of all the stories you need to know to get your day going in today's edition of Daybreak, which as ever, terminal subscribers can find by going to DAYB Go. Now, let us turn to Asia and China's factory gate inflation easing for the first time since the Iran war broke out. Consumer prices also decelerating in another sign that cost pressures from the oil shock are starting to fade. We can go now to Bloomberg's Min Min Lo in Hong Kong. Min Min, good morning. Do these figures reflect energy price corrections or weaker domestic demand? What do you think?
Well, it's a little bit of both, right? Because we did see energy prices cooling down, and that has been a major drag on the consumer price index. But at the same time, it's because domestic demand has been weak, so that hasn't been able to offset the drag in oil prices. So a lot of the inflation that we had seen so far that returned to China was largely imported inflation rather than demand-led inflation. And you add to that, we saw the Politburo meeting recently also didn't really unveil any new demand-targeted sort of broad-based stimulus, and that has been quite disappointing. So just to recap the numbers, you can see that CPI is just 0.5% versus estimates of 0.8%. PPI came in at 3.5% versus estimates of 3.9%, and it's a slowdown for both prints from the previous month. So there is the fear that with things cooling down in Iran, perhaps that deflationary pressure will be coming back to China once again.
Yeah, how much should we be returning to that deflation risk narrative in China?
Yeah, so far we have been seeing a K-shaped recovery aside from the very narrow sectors of energy and tech that has been doing very well. The other sectors like traditional manufacturing and the like, they have not really been able to pass on higher costs to consumers because people are still hoarding their savings instead of spending. And this is something that is very, very sticky, and it's been hard for the government to really change that pattern. It requires really an injection of confidence in the economy. But so far, because because PPI has returned back to 3.5%, at least we are, much, much better than where we were a year ago when things were deep in deflationary and negative levels for at least several years. So that's why the government has not been so urgent about these stimulus, and instead they have been focused very much on, creating monetary tools to support fundraising for the tech sector, and it's leaning really hard to really support the high-tech manufacturing, and that has been the key bright spot for the economy, especially when you look at export numbers. So it seems like for now the strategy is going back to the old playbook of pushing hard on manufacturing, hoping that would be enough to lift growth. But again, certain sectors, the consumer sectors, are going to see a pretty prolonged sort of lag in this moment.
Yeah, it was interesting to see some of the luxury names looking at pork prices to gauge demand from China. And indeed, we're seeing the cost of pork narrowing its year-on-year decline, a sign that oversupply is easing in the hog industry, just for those who have an interest in pork markets. Min Min, thank you so much for the analysis. That's Min Min Lo in Hong Kong. Now, let's come back to Europe and turn to earnings season as it continues, but ongoing disruption in oil and shipping markets boosting the energy majors and container lines, with Maersk expected to report second quarter results on Thursday. So we can get a preview now with Bloomberg's Chloe Melly. Chloe, just first of all, before we dive into Maersk, what are the other highlights you're expecting this week?
Yeah, so this is the last busy week of earnings season, and there's going to be a real big theme of energy, but not oil majors. It's more renewable energy. So the wind power industry is going to be in focus. We've got Vestas, which is a wind turbine maker. It's supposed to report quite strong orders, as there's quite strong momentum at the moment in this wind power industry. We also have Ørsted, the other big name in Europe in this sector. And of course, it's had a very difficult 2025. We had the rights offering last summer. So it's still working on sort of repairing this investor confidence, but it should show that it is currently on track to do that. In Germany, there's also RWE and E.ON, and so both of those companies, those energy companies, are benefiting from the same dynamics, which are this growing electricity demand from data centers, and then also the rising investment in grid infrastructure all across Europe. And so because of those tailwinds, those two companies are also expected to report quite strong print as well this week.
OK, and let's also just talk about Maersk, because it raised its guidance in June. What's the war boost expected to be?
Yeah, so it's going to be it's going to be the same dynamics really playing out for Maersk. Obviously, as you mentioned, raising its guidance in June, and a big part of that was those rising container rates because of that disruption in the Middle East. Those tensions are still there, and so the rates are still elevated. They are starting to come down a little bit, but we're still about 70% higher than we were a year ago. So it's still going to be benefiting from that and feeding into quite strong second quarter results we're expecting. If we go a little bit further into the year, there's going to be other things playing out. There's going to be rising supply of new vessels, of new ships, and then also gradual return of normal traffic through the Red Sea. And so that could actually pressure rates a little bit and could mean that there's fewer tailwinds for Maersk going forward. But for now, for this particular set of results, it's expected to be pretty robust.
OK, Chloe, and of course that feeds into the macro story as well. So really interesting to keep an eye on those earnings. Bloomberg's Chloe Melly there. Thank you very much. Now, let's turn to another of our top interviews this morning. The New York Stock Exchange is optimistic on the IPO pipeline for the remainder of this year and next, with demand from all sectors, not just technology. Its president, Lynn Martin, spoke exclusively to Bloomberg.
At the NYSE, we pride ourselves on being the gold standard of listings. The micro caps was not something that was uniquely focused on the New York Stock Exchange. In fact, I don't know that it was that we were the home to many of the companies you've just referenced. It's why we've been so deliberate in continuing to look at our rule set and uphold the rules and listing standards that we have. It's why when you look at the New York Stock Exchange, the median market cap of our companies is 15 times that of our closest competitor. Because from our point of view, it is about providing responsible access to the best, most well-governed companies around the globe.
Are you seeing a change in attitude at all, or appetite in terms of dual listings, in terms of companies wanting to keep their hometown presence while at the same time tapping that US depth that you mentioned? Or do you find that companies just prefer that singular clean listing with the NYSE?
Well, we think the regional markets, particularly those in South Korea, play an incredibly important role, particularly when you look at the customers that they serve as their home base. So we've been really focused on continuing to further the dual listings, the ADR frameworks that have existed in the U.S. for decades, centuries, if you will, in the case of the New York Stock Exchange. And from our perspective, the regional markets play such a critical role from a capital formation standpoint.
So do you expect to see more ADR listings from firms here in Asia? And which markets do you expect to see those coming from?
Yeah, we're really optimistic about the pipeline that is generated out of Asia, out of this region, but also globally, as companies, as part of their capital formation, don't just look to the retail markets. They look at the opportunities that the U.S. capital markets, the deepest, most liquid markets in the world, present from a globalization of the investor base. So we see these opportunities continuing to play out for the remainder of 26, but importantly into 2027 as well.
Well, the NYSE parent company is looking at exploring partnerships with other groups like Polymarket, OKX as well. I understand you've also got an application in for 24/7 trading. Before we let you go, can you give us a quick update on those things?
Yeah, so if you look at extended hours trading, so we're leading the industry in the move towards the traditional markets going 23/5. That will actually happen in December of this year, where the securities markets will bring the regulated framework, the regulated protections that come with that framework, the stability, the resiliency to a 23/5 hours, which what that means is global investors will be able to invest in our regulated markets, ones that exist today, with a lot more certainty.
That was Lynn Martin, president of the NYSE Group. And coming up, we'll turn our attention to tech. Unauthorized AI model hacks are raising global cybersecurity fears, so we'll get more on that story next. This is Bloomberg. Welcome back to Bloomberg Daybreak Europe. Just coming up to 6:45 a.m. here in London. Well, OpenAI model's hack of Hugging Face has put AI-enabled cyber attacks into the spotlight. The incident and similar breaches reported by Anthropic and Meta have fueled calls for more thorough safety reviews of AI models. With me now to discuss is Jordan Robertson, Bloomberg senior cybersecurity reporter. Really good to have you with me. Round the desk on Daybreak Europe. I mean, this stuff sounds really scary. You've got AI agents leaving notes for each other, working together to break out of their testing environment. Surely this sort of thing, these breaches, are just going to get more and more sophisticated, more and more commonplace.
Yeah, it's been a really interesting couple of weeks. I've covered cybersecurity for a really long time, and we've never seen hacks like these. We've never seen, first of all, hacks where companies are hacking the internet. It's always bad guys, it's criminals or cyber hackers or spies or whatever. So you have trillion-dollar startups in some cases not having control over these models. And to your point about kind of how these AI models are hacking, they're exhibiting a lot of creativity and imagination and kind of ingenuity.
In ways you wouldn't have expected?
Not really. I mean, like, if you think through how these AI models are trained, they're trained on us. They're trained on TV shows and movies and books and things like that. So, people lie and cheat and deceive and steal. And so, like, the models will too. But a lot of these people that are running these cybersecurity tests, they said they've been very surprised at the degree of ingenuity that these models exhibit when they're performing these hacks.
So then what could come next? And let's just hope they're not listening and processing what you're about to say. But, can you predict what the next step will be?
Yeah, I think anything you could imagine a human doing, imagine these AIs doing, just better and kind of more thoroughly. And so what has been so remarkable about these past couple of weeks, these AI models, they're checklist machines. Like anything you could do to hack a network, they will do, but they will do more thoroughly than any human ever would. So, and what these companies have shown is that they don't have great control over these models in these testing environments, or sandboxes as they're called. This is very well understood science. This is not rocket science in terms of how to contain these things.
And so if the companies don't have control, is there any hope for the regulators, or is the only answer to just shut stuff down?
No, I think there is a role for the regulators because, again, companies could control these things. Like cybersecurity researchers for many, many years have used what are called sandboxes. These are just software environments where they can test dangerous software. And it's very well understood. It's really not that hard. What these examples are showing is that these frontier AI model makers, that they have not implemented the right controls in these testing environments. They could be forced to do that. They just haven't been until this point.
But why not?
I think it's a race. I mean, it's a race to get the most powerful models out. And in that race, the priority is developing the most powerful model, testing it quickly, and getting it to market. Again, testing dangerous software is a very well understood practice. What's happening here is that these companies have just not been forced to implement the right controls. And now we've seen these models either escape or just be let out. I mean, in many of these cases, it's just been mistakes.
But I feel like that's the scary bit, that it seems like caution's just being thrown to the wind because the companies are more focused on the race between each other than the safety itself.
Yeah, it's really stunning. There's one company at the center of a lot of these incidents. It's called Irregular Security. It's a venture-backed startup. It doesn't look like it has a lot of experience in cybersecurity, but it's gotten a lot of these contracts to test these frontier AI models. And what's happened in a lot of these cases is there have been kind of basic mistakes that have allowed these models out onto the internet to do all these things. And those mistakes shouldn't have happened. Like these companies have said, well, Irregular Security mistakenly allowed these models access to the internet and they shouldn't have. That's like a setting. That's like a setting control. But to your point earlier, once these models reach the internet, we're learning a whole lot about what they actually do and what they're capable of and the creativity that they're capable of. As you mentioned, leaving notes for each other, having the awareness and the understanding that I might not be able to get where I need to get on this network, but if another model is following me and is able to do these things, I'm going to leave some instructions for that bot to then execute my tasks. It's really extraordinary.
But that's interesting because they've learned from us and now we're learning about their behavior from them. So
absolutely. No, it's fascinating. We're learning a lot about their capabilities, but also about how to secure these networks. They're exposing a lot of holes in the way these networks are secured. So there are benefits to these kind of model escapes. We're learning a lot about what they're capable of. And I mean, we haven't even scratched the surface, at this point. We're going to see a lot more of these. We have no idea how often these attacks are happening right now. We've only seen a few examples where companies have disclosed them. There's no way to measure on the internet how often are frontier AI models hacking people. There's just no way to do that. So this is happening right now. You joke about, are they listening? They are. They're being trained on TV programs and books and everything else. So they're learning from us constantly. And so we should learn a little bit from them.
Oh, my, I'm quivering in my seat here, Jordan. You've got a fantastically exciting beat right now. That's Bloomberg's Jordan Robertson. Now, to some other top stories that we're following for you this morning. TSMC has reported a 45% rise in monthly sales, signalling a sustained demand for AI hardware despite the recent market volatility. July revenue reached a $14.5 billion. Last month, the company raised its spending and revenue forecasts, expecting strong demand for AI chips to extend into 2027 and beyond. Elsewhere, UK Prime Minister Andy Burnham is launching a nationwide tour to promote new measures aimed at easing the cost of living. He'll announce plans targeting misleading discount advertising and subscriptions that are difficult to cancel. But the moves risk being overshadowed by growing scrutiny of his approach to early prisoner releases to reduce overcrowding in prisons, with public anger over the potential releases of some criminals. Staying in the UK, hiring at British businesses held steady in July, ending a downturn stretching all the way back to the Liz Truss crisis in 2022. A survey from the Recruitment and Employment Confederation and KPMG says that temporary vacancies rose for the first time in 2 years, while demand for permanent workers declined at a slower pace. And staying with the eco data, euro area growth is expected to pick up after showing surprising resilience to the Iran war. A Bloomberg survey of analysts now forecasts the economy will expand 0.8% this year. That's up from an estimate of 0.5% last month, largely reflecting stronger than expected growth in the second quarter. Well, those are some of our top stories from around the world this morning. Plenty more coming up. We'll bring you some Bloomberg terminal charts to frame your thinking for the day and week ahead. Stay with us. This is Bloomberg Good Morning.
We have a very K-shaped economy, and that's not very good for for people selling to the broad mass of consumers. But it's very good for those who are essentially the beneficiaries of the spending of the very rich, because what do the rich do? Well, they buy stocks and bonds, and that's been pouring money into the market. So I think the market is really outperforming the economy by a lot.
So that was the JP Morgan Asset Management Chief Global Strategist David Kelly there on the divergence between markets and the economy. But let's just look back at some of the economic data that we got out of the US last week. Of course, it was the big jobs report, and we had that huge downward revision, the biggest of the year, which entirely erased the upward revision in May. And as you can see here, the participation rate continuing to slide along with hourly wages, the blue line down there. That blue line is what sets us up for the inflation print on Wednesday this week. Do we see inflation outpacing wage gains going into the midterms in the autumn? That'll be the big question for Wednesday. One of them, but flipping the board over, in terms of where Friday's data left Fed bets, as you can see, they fell in short. You saw the implied probability of a September hike falling the most since June to 42%. And then you also saw the probability of a December hike falling the most since July to 44%. So that is the white line here. And so less than a 50% chance on both. Treasuries rallying across the curve in response, though this morning we have seen yields higher at the front end because of the lack of progress that we've seen in the Middle East. Nonetheless, flip the board one more time. We keep an eye on gold in response. The one and done narrative immediately having led to a pop in gold, rising, as you can see, above its 50-day moving average for the first time since that sell-off in March. The bulls inching back. But this morning, last I checked, we had the yellow metal a touch weaker, even if it's still above that $4,300 an ounce level. Now, to get all of these charts and all the others that we've been using on Bloomberg TV throughout the day, do go to CHRT TV Go on the terminal, an incredible bank of charts for you. These are the risk events for the week. We've talked about US inflation. We've got 3 big oil reports as well. And, of course, on Thursday, we've got UK GDP very much in focus with this new Labour government under Andy Burnham. The opening trade's coming up next. Skylar Montgomery-Koning will be alongside Guy and Tom this morning. They'll take you all the way to the market open. Stay with us. This is Bloomberg.